Oil just ripped to $90, while gold stalls near $4,000. That split means your war premium is already expected by the market crude, not the yellow metal. Tuesday, July 21, 2026. Like and subscribe for daily market updates. Today's agenda: Market Snapshot, the crude surge explained, why gold won't rally, crypto vs global conflict, Fed policy impact, what to watch next. Up next, the crude surge explained. Let's look at where things stand right now. Bitcoin is trading up nearly 2% to $66,481. Ethereum is also positive, sitting around $1,941. But the stocks are mixed. The Nasdaq barely moved down 0.05 of a point, while the S&P 500 slipped less than 0.1% at 7,443. Gold holds above 4,000, but only gained about 2 points to reach 4,064. Oil is louder today, climbing 18 percentage points to $84 after hitting that $90 mark earlier in the week. The dollar index stayed flat around 101, and 10-year yields are hovering near 4.6%. If oil is the loud market, then gold being stuck at 9-month lows makes no sense unless you understand what's happening with real yields next. Let's talk about why precious metals are struggling here. The surge in oil prices stems not from headlines alone, but from compounding supply shocks threatening global energy security faster than markets can digest them. This rally is driven by three converging threats: catastrophic infrastructure damage, labor contraction, and global political interdiction. Active fires on tankers within the strategic Hormuz Strait physically block a critical artery through which nearly 20% of the world's oil flows, creating immediate bottlenecks that ripple across global refineries. Simultaneously, Kuwait has faced an unprecedented 4-day strike by its workforce, halting production from one of OPEC+'s most reliable members, and raising interest rates inventories just as demand remains resilient in emerging economies. Adding further friction is the escalating Houthi campaign targeting commercial shipping lanes through the Red Sea. This forces vessels onto longer detours around Africa or into high-risk zones, effectively raising freight costs and reducing available supply capacity without a single barrel being burned. Brent crude recently breached $90 before settling near $84 today, yet it has already climbed over 12% in just 1 month, a move that defies simple panic-buying narratives. Instead, sophisticated traders are aggressively pricing the reality of tangible physical disruption rather than abstract fears of conflict escalation. Historically, we saw similar spikes during 1973 and 2020, when supply chains fractured unexpectedly. However, this current convergence creates a unique second-order effect, where inventory drawdowns become unavoidable, even if hostilities pause momentarily. For investors holding energy assets or hedging portfolios against inflation, the implication is clear. Unpredictable price swings will persist until either strikes end, fires are extinguished, and shipping routes stabilize. The market is no longer betting on war. It is calculating the precise cost of moving barrels through a fractured world, where every mile lost to fire or blockade translates directly into higher fuel prices at the pump and increased operational costs for industrial sectors worldwide. If gold is struggling despite global chaos, then crypto must be doing something different, which brings us to Bitcoin's surprising strength today. Here is the shock nobody expected. Despite a full-scale war in Europe and oil hovering near $90 per barrel, gold remains stubbornly stuck at 9-month lows around $4,640 today. This disconnect reveals traders are pricing persistent inflation rather than immediate doomsday scenarios or hyperinflationary collapses. The mechanism driving this stagnation lies in the shifting calculus of real yields. As interest rates stay elevated across major economies, bonds and high-yield savings accounts offer guaranteed returns without global political exposure. This environment actively punishes non-yielding bullion, because holding physical gold incurs an implicit opportunity cost never, so punishing for institutional managers who can secure roughly 4.5% risk-free returns elsewhere with zero counterparty risk. Historically, similar decouplings occurred during periods of strong dollar strength and strong growth in the early 2020s, where gold struggled despite global instability as capital flowed into fixed-income markets seeking safety and yield simultaneously. The second-order effect is a structural rotation away from traditional hedges. Investors no longer view gold as an insurance policy against chaos, but rather as a liability that dilutes portfolio performance when real rates climb above 3%. For the concrete investor, accumulating ounces out of fear may be premature until central banks' rate change toward rate cuts or fiscal deficits spiral to force monetary expansion again. Until inflation expectations rise significantly faster than nominal interest rates, gold will likely remain range-bound as capital chases yield over speculative store-of-value narratives. If digital assets are ignoring war news, then what about Ethereum beating Bitcoin in this strange new dynamic we're seeing across the entire crypto ecosystem today? 10 nights of relentless bombing across the Middle East have barely dented Bitcoin's momentum. Prices climbed back above $65,000 today at exactly $66,500. This surge isn't panic buying driven by fear. It signals a profound structural shift in market psychology, where digital assets now react more sensitively to Federal Reserve policy than global conflict alone. Investors increasingly view crypto as a hedge against anticipated central bank policy mistakes and currency debasement, specifically the risk of an inflationary spiral triggered by massive war spending, rather than merely serving as a safe place to store wealth from global political instability. The prevailing narrative has decisively moved away from the historical axiom that war is bad for tech toward a more nuanced reality, where inflationary war spending might be good for risk-seeking flows. Historically, during periods of acute crisis like the 1973 oil shock or recent Middle East tensions in early 2024, traditional stocks and bonds often suffered as capital fled to safety. However, this time differs because central bank balance sheets are already bloated with available cash in the market from pandemic-era stimulus. When governments inject trillions into defense budgets without corresponding tax hikes, the resulting money printing threatens long-term purchasing power more than immediate instability does. Consequently, assets offering uncapped upside and no correlation to traditional inflation metrics become attractive stores of value even amidst chaos. For concrete investor implications, this dynamic suggests holding digital currencies may provide superior protection against stagflationary scenarios compared to gold or treasury bonds in a high-spending environment. The market is essentially pricing the expectation that excessive fiscal expansion will eventually force central banks into aggressive raising interest rates later, making today's risk assets a strategic play on future available cash in the market cycles rather than a blind bet on peacekeeping. Stability. With the Federal Reserve holding steady but oil prices climbing, what happens next for your portfolio depends on how these two forces interact over coming weeks ahead, before earnings season kicks off later in August timeframe, starting mid-month Tuesday, Wednesday, Thursday, Friday schedule rotation. Weekly. The Federal Reserve's latest communications hint at potential pause in raising interest rates, yet fixed income markets remain unsettled, with 10-year Treasury yields stuck near 4.6%. This stagnation reflects a tug-of-war between cooling labor data and persistent inflation driven by AI infrastructure spending. Could AI-driven price pressures force policymakers to reconsider their stance? The answer lies in wage price spirals. If tech productivity gains fail to boost broader efficiency, unit labor costs could rise faster than output, necessitating higher rates rather than a pause. This mirrors 1974, when energy shocks stalled rate cuts before inflation re-accelerated, forcing aggressive hikes that crushed bond prices for years. The new Fed chair's tight-lipped approach compounds uncertainty, as investors seek clarity on whether policy will rate change soon or remain in favor of higher rates longer. Without this signal, capital allocation suffers. Equity how expensive assets look relative to earnings in rate-sensitive sectors like utilities, and real estate face challenges with elevated discount rates, while small-cap stocks struggle amid a lack of available cash in the market rotation into defensive havens. Furthermore, currency dynamics play a second-order role. Prolonged ambiguity keeps the dollar strong, squeezing emerging market debtors even if domestic inflation cools. For institutional investors, this environment demands shifting from beta-seeking strategies to alpha generation through duration management and sector-specific hedges against sticky services inflation. The path forward requires actively modeling scenarios where policy shifts occur faster or slower than consensus expects, as every basis point of delay in rate cuts directly erodes returns across global fixed income portfolios. Finally, let's turn to what to watch next. Chip stocks surged today, driven by resilient semiconductor demand in rebounding Asian stocks despite broader challenges. Yet the S&P 500 closes lower as soaring crude prices inflict direct margin pressure on energy-intensive sectors like manufacturing and global transportation logistics spanning multiple continents simultaneously. This dynamic creates a divergence. Technology firms with low carbon footprints thrive, while industrial giants struggle to hedge against volatile fuel costs, eroding profit margins across the supply chain. Historically, this mirrors 2014-2016 when oil spiked above $95 per barrel, forcing manufacturers to cut capital expenditure and slowing global growth until prices stabilized. Investors must now watch if current inflationary pressures trigger similar defensive rotations away from heavy industry toward tech or services. Meanwhile, the crypto regulatory landscape reaches a critical turning point, where legislative clarity appears imminent according to recent reports suggesting action may come sooner than expected, before election year pressures mount throughout the next 12 months. The mechanism involves Congress rushing finalization of digital asset frameworks to avoid market uncertainty that has plagued institutional adoption for years. Without clear rules, banks hesitate to integrate blockchain rails due to compliance risks. Second-order effects include potential capital flight into stablecoins or traditional stocks if regulatory overreach stifles innovation too aggressively before the election cycle concludes. For investors, this implies a strategic rate change. Those holding energy-heavy portfolios face immediate valuation compression unless they secure long-term fuel contracts, while crypto holders should monitor bill progress closely, as clarity could unlock trillions in institutional inflows once legal hurdles are cleared next year. In conclusion, the markets are telling a complex story, where traditional safe havens like gold fail to rally despite global conflict, because high real yields make them unattractive compared to bonds. Meanwhile, Bitcoin continues its ascent driven by Fed policy expectations rather than war news headlines alone. Investors must navigate this new landscape carefully as oil prices threaten energy-intensive sectors, while digital assets seek refuge in monetary stability narratives. Keep an eye on upcoming economic data releases and central bank communications for the next major market move. Thanks for watching Market Pulse Daily.